Good day everyone, thank you for joining me. I'm Tamara Kukshinovich and I'm going to take you through the Attacq EIA. In March, Attacq released interim results. The highlights were as follows. Rental income decreased 1.3% to 1.1 billion rand, but grew 0.4% on a like-for-like basis. Cost to income decreased from 35.5% to 33% for the waterfall portfolio, and increased from 36.9% to 43.4% for the non-waterfall portfolio. Net profits from property operations decreased 0.9% to 738.2 million rand, but increased 3.4% on a like-for-like basis. The group recorded a loss of 397.4 million rand for the year. Total core distributable earnings fell 57.5% to 21.1 cents per share. The board has decided not to declare an interim dividend as guided in the year-end results. Additionally, no guidance will be provided for FY21. Interest-bearing borrowings increased 0.7% to 11.5 billion rand. The weighted average loan term fell from 3.2 years to 2.8 years. The interest cover ratio deteriorated from 1.7 times to 1.4 times. The loan-to-value ratio increased from 45.7% to 46.3%, and NAV per share declined 4.5% to 15 rand and 71 cents. The market's reaction was neutral after the announcement, with the share price closing at 606 cents per share on the day. This represents a decline of 0.3% in the share price. Since our neutral recommendation in September 2020, Attacq outperformed the SAPI index with a return of 74.8%, while the index returned 35.6%. Year to date, the share price has also outperformed the SAPI index with a return of 28.4%, while the SAPI returned 6.1%. On a price-to-book basis, the group is currently trading at a 41.8% discount to its peers. It is also trading at a 40.4% discount to its 5-year average. The group's balance sheet is stretched with a loan-to-value ratio of 46.3% and a weak interest cover ratio of 1.4 times. The group only has 8% of debt expiring in the next year, so there is enough liquidity to meet this commitment. On the other hand, 64% of debt is expiring in the next 2 years. Currently, the group does not have enough liquidity to meet this commitment, but has provided guidance on how it plans to tackle this problem by refinancing and using disposal proceeds to settle debt. Positively, the group only has exposure to traditional bank debt. The lower rental growth outlook has resulted in group assets being impaired by 3.2%, with the biggest decline coming from retail, followed by office. Fortunately, the group is diversified on a sector basis. The South African portfolio, which is approximately 83% of total assets, has exposure to retail and office and mixed use of 48.2% and 41% respectively. Because of this high exposure, the pandemic has highly affected the portfolio. We anticipate recovery to be closely linked to South Africa's macroeconomic outlook. To address the balance sheet problem, management has part disposed of its mass investment and plans to dispose of the rest of African investments. Attacq will also not declare an FY21 dividend and is extending debt repayments expiring in the near term to create a more staggered debt repayment profile. The board has not declared an interim dividend to have financial flexibility and preserve liquidity. Additionally, management has decided not to provide any guidance due to the high level of uncertainty. While we recognize a difficult valuation cycle ahead, we feel that a significant amount of bad news is incorporated in the share price, with the share trading at a 61% discount to its NAV. We maintain our neutral recommendation for a property-only portfolio mandate. If you'd like to place a trade, please speak to your financial advisor or contact the dealing desk. Additionally, the report on Attacq can be found on MyBase. But before we end off, please take note of the following disclaimer.